This video, we're going to be learning about basic transactions when money is coming into a business. So we're going to start with this first transaction. The owner invests $5,000 on July 1 to start the business. Firstly, we need to think about what accounts are going to be affected. So if $5,000 is going to be put into the business, that means that our bank account is going to go up by $5,000. So over on our chart of accounts, under assets, the first account that's going to be affected is our cash at bank. The second account that's going to be affected is a special type of account called capital under the owner's equity. Because the owner's put in his own money, this is the other account that's going to be affected, the capital account. We can now go ahead and fill out this transaction. So we're going to start with the date. The date was July 1. The accounts affected, there were two accounts affected. The first one was cash at bank. The type of account, so cash at bank over here on our chart of accounts, cash at bank is an asset. So I'm going to write asset in here. The nature of asset accounts. Down here in our accounting rules, we can see that assets by nature are debit accounts. So it's debit by nature. Is it increasing or decreasing? So $5,000 has gone into the account, so it's increasing. When an account increases, then it stays the same. So it's going to stay as a debit, DR, and the amount is $5,000. The second account affected was our capital account. Now the capital account, the type of account it is from our chart of accounts, it's an owner's equity account. The nature of owner's equity accounts, if we have a look here at our accounting rules, owner's equity by nature are credits. Now again, it's going to increase, so it's going to stay as a credit for $5,000. We can just do a quick check here. Our debits always have to equal our credits. So we can see here $5,000 debit equals $5,000 credit. Let's look at a second example. The business makes cash sales of $6,000. Cash sales, $6,000. Two type accounts are affected. If we look at our chart of accounts, the first account that it's going to be affected is our sales account because we've made some sales. The second account is going to be our cash at bank account because we've made $6,000. $6,000 is going to go into our bank account. Let's now fill out our transaction. So on June 2, our first account affected was sales. The type of account sales is, if we have a look up here, sales is a revenue account. Revenue, another word for revenue is income. So the type of account, it's our income account or revenue account. The nature of income accounts, they are credits. We've made sales, so it's going to increase. When it increases, the nature of the account, it stays the same. So it's going to stay a credit for $6,000. The other account affected was cash at bank. Cash at bank, we know, is an asset. From over here, our chart of accounts. Nature of assets accounts, they're debit by nature. Our bank account balance has gone up because we've made money, which means our account stays the same and the amount is $6,000. You can see here our debits equal our credit. The next transaction on June 2 says that we received $2,000 from J. Smith for settlement of their account. Alright, so we've received money, we received $2,000, so we know one account that's going to be affected is our cash at bank. The other account that's going to be affected is actually our accounts receivable, which is in here, accounts receivable. This is because we were owed $2,000, so we were due to receive $2,000, and we've actually now received that money. So they're the two accounts affected. Let's now fill out this transaction table. The date is June 2. Accounts affected. The first account was cash at bank. We know cash at bank is an asset account. The nature of assets are debits. We've received money. Our bank account has gone up. It's going to stay a debit for $2,000. The other account affected was accounts receivable. Accounts receivable is also an asset account. Assets by nature a debit, but this time our accounts receivable balance has gone from $2,000 to zero. They no longer owe us money, so our balance has actually decreased. When there is a decrease in an account, the account switches from a debit to a credit. So that's going to be $2,000 credit. You can see here our debits equal our credits.